Welcome, everyone, to the
I gotta face
Pirates
the
of
other
Finance,
way.
where we can't seem to get our shit together. This is the show where we're supposed to be talking about finance, but are currently dealing with technical difficulties. My name is Corey Hoffstein, the man trying to fix his mic and his video to, I guess, on screen right. That is the man, the myth, Jason Buck. The man trying to corral us into actually figuring out how to record appropriately behind the scenes is Mr. Jack Farley. You're watching on Blockworks. Thanks for joining us. We had a wonderful idea today because Jason just so happens to be in Grand Cayman at the moment. And we thought, wouldn't it be wonderful to record a live show? So Jason shows up at my house 30 minutes early. He starts setting everything up. I'm totally unprepared. I'm in the middle of trying to finish some work like an idiot. Jason gets the whole thing set up, and within 3 minutes to spare, we log on and we say, Jack, surprise. We're going to try to do this in the same room together. And Jack says, you idiots, that's going to create a tremendous amount of echo. And so that's where we're at. Jason was just scrambling to run out to another room to try to get this set up. But here we are. We're live. I think we're going. Jason, you all set? You settled?
Yeah, this is really weird because Corey's actually right over my shoulder. I'm not sure if you can kind of see him in the background. And I was trying to give you guys a nice shot of the ocean here in Cayman, but oh, there you go. You can see you waving. It's the backlighting is just too tremendous. So unfortunately, you're gonna have to look at my ugly face instead of looking at the ocean the whole time. But maybe that'll focus everybody's attention, and you can look at Corey instead.
Yeah. So today we're trying something new, though, Jason, because I think this week has been so chaotic and you and I have been so heads down in just work. We haven't even thought about what we're going to talk about. And rather than talk about nothing, we put it on Jack behind the scenes to come up with 7 questions that we have no idea what the questions are. But Jack is going to ask us 7 questions, and we're going to tackle them one by one and see where it takes us. So, Jack, why don't you come in and maybe is that the format, Jack? That's what we're doing?
Hey, Corey.
Did I nail that?
You nailed that format. Here is the first questions. What lesson can we learn from the collapse of Luna and Terra? What parallels can you draw, if any, from your prior work and research on iron finance?
Ooh. Corey, you want to start or you want me to start?
Well, this one is easy. I don't know if I can go for 7 minutes. Don't invest in Ponzi's.
Like, that's what you learn from iron finance?
Yeah. I mean, look, Ponzinomics, if you get in early enough and you're aware it's a Ponzi, that can play out well for you, but you're taking a huge gamble because Ponzi's can fall apart at any time. These sort of algorithmically backed tokens where they are trying to stabilize themselves using one token to stabilize another pegged dollar token, and that other share token that they're using doesn't even have any intrinsic value, is going to eventually lead to a bank run. Iron finance, it happened last summer. It just happened with Luna, and it's always going to happen unless there's something backing from an asset perspective, more structurally, the create-redeem mechanism of that peg. When it's all Fugazi, it's not going to work.
Yeah, I think that, we've been saying from the rooftops for a long time that any sort of algorithmic stablecoin is not going to work. I mean, the only way it could potentially work is if you get to such a scale that then you can diversify, right? And that was actually the implicit goal of Terra and Luna, was to eventually get to that size. But like that's very difficult to happen, and this is why both, it's mathematically sound and economically sound. The problem is it's not sound with just human beings and our incentives. And our incentives are, if something starts to depeg, I'm going to get scared and I'm going to run for the exits, and I'm going to try to beat everybody out the fire door. I don't care what mechanism they have in place to try to rebalance the stable coin. And actually, it goes way back for me, especially in the crypto stablecoin space. I highly recommend anybody go back and read Nevin Freeman's, one of the founders or co-founders of Reserve Crypto, and he used to write a lot. They were trying to build stable coins. We're talking maybe 5-6 years ago, and one of the things they came across was talking about stables, and he pointed out in a very detailed way on their blog about how things like, at the time I think he was talking about DAI, but we've seen a lot of stables, algorithmic stables, come and go. And I mean, DAI is over collateralized, but you could still have a run on the bank on DAI. And Corey and I were talking privately and publicly about, this could potentially, what's scary is, and Nevin had pointed this out, he was afraid 5-6 years ago, what happens when a stable crypto gets like $1 billion and we have a run on the bank, and then does that send shockwaves to the system? Now we had $30 billion into a stable that like sent shockwaves through the system as it depegged all the way down to like 28 cents, 29 cents, I think, went at one point overnight. Sorry, Corey, you were going to say something.
No. I think, right, it's one thing when it's isolated, like Iron Finance, which was sort of a weird side chain phenomenon that crypto native people lost money on. But when you start talking about Luna, there's two things interesting there. One, it had VC backers, right? So there's real money consequences here. This isn't like crypto squared type money. This is like people invested from traditional finance that has knock-on effects into, in theory, the real world. And then two, I think the sadder part to me is that there were consumer finance applications that were holding themselves out as savings vehicles with enhanced APYs that were really just crypto lending, and they were trying to take advantage of the earnings you had over in the Terra ecosystem on the Anchor protocol, which was in theory stabilizing this whole Ponzi, and you were getting about 20% per year. Unsophisticated people who thought they were just getting a higher savings rate just lost a whole lot of money. So there's some really sad aspects of this whole situation. You talk about the knock-on effects into crypto, Jason. You have said for a long time, imagine a run on USDT. If USDT Tether depegs, man, there's so much leverage in the system that you could see a real cascade, a real sell-off in crypto prices. And there was actually a tweet that I saw from someone. And again, this is the weird thing about crypto. Everyone's anonymous in crypto. This person's name is CL207 on Twitter. Sort of LARPs as a cat in a hazmat suit. But actually, behind all that might be one of the best Bitcoin traders I've ever heard of. Anyway, he said he did the work, and he poised it as he did it while on like an LSD acid trip, but did the work on what would happen with a Tether depeg, and said that the actual, if you look at what Tether is collateralizing, it's collateralizing far more shorts than it is longs right now. And so if you actually had a Tether depeg, it would force shorts to cover a tremendous amount, and it could actually drive the price of crypto up, not down, in a short squeeze.
But there's been a lot of talk too that like a Tether peg and running through the fire exits on Tether would lead to a massive amount of Bitcoin buying, and that people think the price would rise with Bitcoin very similarly. But I think as we find out, and it's actually been surprising how well Bitcoin and Ethereum have been holding up, what's gone on with Terra and Luna or UST, is the idea that people find out what money is. And this is what happens, right? Everything that we think has moneyness, as soon as we start seeing fragility in systems, everybody wants to go for what's real money, and everybody's going for fiat cash. And so it doesn't really matter what the positioning are in these. Like, that's what I'm saying. You could talk about what should happen rationally or economically, but human beings have incentives, and then we try to figure out what cash is and when we need it most, and everybody's trying to run, and it leads to a feedback loop. And I think everyone knows I'm a fan of like Hyman Minsky, and the idea of Minsky had like credit cycles, bank cycles, but I'll talk about the bank cycle really simply. And he had what we call the hedge cycle, when everybody's conservative and banks provide loans and people are able to pay back the principal and interest. So it's very conservative environment, right? Then as the economic activity picks up, then we move into the speculation phase. And in the speculation phase, they give out loans and people can only pay back the interest. They can't pay back the principal, right? And that's when things really start taking off. And this is Hyman Minsky's idea of stability breeds instability, because as the economy is taking off, these loans look better and better. As the asset values keep rising and rising, he gets to what we call Ponzi finance. And that's when you can not only now can the debtors not only pay their principal, they can no longer pay the interest, but they're using new forms of debt to pay back the previous forms of debt. And that's that speculation turns to Ponzi finance. And then because all the players are actually sophisticated and smart and know what's going on, they're all very nervous. So as soon as you have a little pinprick, it leads to the cascade of consequences. That's a feedback loop until we crash down to what's money again, and then the whole cycle starts over. And part of that is, and I think this is what happened with Terra Luna, is everybody kind of knew it was a Ponzi. So that's why you see these moves happen so quickly, because people deep down, they knew exactly what was going on. And so they're rushing for the exits. They're trying to be first out the exit because they knew that what they were doing wasn't, there wasn't really any there. But at the same time, like Corey said, this is a very sad situation. And I know people that were lunatics and had a lot of portion of their net worth in there. And it's very sad for people to see this wiped away. And we saw it go from a value of over 40 billion to, I think one of the last times I checked, it was like under 2 million. So I mean, that's like worse than Lehman Brothers. I mean, that is some serious, like 40 billion just got wiped off the face of people's savings.
It'll be fascinating in 10 or 15 years when the history books are written about this era of crypto, how this all gets looked back upon. You know, I mean, it's hard to look at that and say rational actors would have a lot of money in there. That said, I had money over in the Luna ecosystem in bonded ETH that I was borrowing UST against and then lending UST for 15%. But I will also say that the first sign of any sort of issue, I unwound the whole thing, moved it out, got it off the ecosystem. Could I have lost it? Yes. But again, I diversified my bets. I went in knowing it was a Ponzi that would fall apart eventually. And I always knew that I just had to cut and run and take losses if it ever seemed like it was going down. So it's possible it could have been worse for me. I don't know. It's sort of the interesting idea of like, can a rational actor invest in a Ponzi? Maybe I'm just irrational.
Irrationally rational. Jack,
right.
Are we up on time? We're trying to figure out this new system, if we're up on time or not.
Yes, that's
like a bell.
That's perfect.
Like, ding,
yeah,
ding,
yeah. Next week, Corey, which is always my motto. Next week. All right, this question is T-ball for you guys. What was the most overrated narrative in all of macro this week?
I gotta tell you, I don't actually know. I've been off of Twitter and most of like, this is actually a tough one. Jason has been walking the beach reading books all week
and working. The one that, I think what was a lot of Twitter this week was dunking on crypto by people that hate crypto. And that was understandable. But I did see a lot of people actually had restraint, which is good. When 40 billion gets wiped off, a lot of people get hurt, and nobody really wants to see anybody get hurt. So that was one of the biggest the biggest kind of macro takes I was seeing on Twitter. What I will address, while Corey maybe thinks of macro take, or I think of one too. In the comments, I saw Sean was talking about Ponzi and malinvestments and Austrian business cycle theory. But this one always is tricky to me. This idea of malinvestment is like, once again, we were talking about human nature with Luna and Terra, and people are going to run for the exits and they want to be the first out the exit. When we say we're awash with liquidity, and I think this is where the Austrians are potentially wrong, is the idea is like, I'm not sure there is malinvestment. Like how do you have a sustainable growing society that goes through booms and bust cycles? And they're probably natural given human nature, is that during the boom cycle, there's going to be tons of what you perceive in hindsight as malinvestment. But take the cables that were laid, the transatlantic cables, the internet, all of that infrastructure was due to a wash of liquidity in the previous cycle, and people would have considered that malinvestment. But now all of us reap the benefits where we're able to do a podcast from the Cayman Islands. So I think one man's malinvestment might be a future opportunity. We just maybe have too short a hindsight look backs to determine what's malinvestment and what's not. And as once again, my goal every week is to just really annoy and piss off the entire audience and make sure that everybody hates all my questions and theories. But that's one of the ones that never made sense to me, the Austrians. Go for it.
This one actually comes from Jason Buck. This is a macro narrative put forth by Jason himself. Jack, this might surprise you. Jason, he said, I believe this fully with all my heart, Corey, let me tell you. And he said that if you were to rewind the clock and consider the counterfactual of what would have happened during COVID, if there was no monetary and fiscal stimulus, we could have had a really deep, sudden recession and contraction in GDP, a lot of bankruptcies, huge unemployment that would have potentially been very hard to get the economy started again. That monetary and fiscal policy may have inflated an asset bubble that is currently deflating as we watch all these assets round trip back to sort of 2020 levels, and we're ending up with what might be a more mild recession, more inflation in the system than we would have otherwise. But in many ways, perhaps the best way to think about this is risk is neither destroyed nor transformed. We have simply smoothed out the recession we were going to get anyway with COVID, and we've now smoothed it out through an asset bubble that's deflating over time into maybe a multi-year bear market and a slight recession contraction in GDP. That has to be the most overrated, idiotic idea I've ever heard.
Corey's just
I actually really like it.
my
I really like the
No,
idea.
yeah, I know you're trying to get me, but the idea of maybe this ties into Jack. What's most overrated is, to me, the idea of like everybody hates the Fed, and it's really easy to hate on the Fed. What I can't imagine is being on the board at the Fed. Like I can't imagine running the Fed. Like what a terrible scenario, especially in March of 2020. And I just wanted to point out the counterfactual, and I hope it's clear. I try to steel man all sides of the argument because I don't believe anybody's right. And so I was trying to steel man the other side is like, what if we want to give the Fed their flowers? Like if we really look at the counterfactual, like how few people starve to death, right? And everybody's going to go, well, now we're pushing it forward now, and we might be, right? Like that's what we could see with food inflation, and we could lead to chaos on the streets. But it's really amazing is actually how smooth the pandy wandy was, and then like how few people actually starve to death, and that may be kind of due to Fed intervention. I don't know. I'm just trying to look at the other side of it, and what we talked about too is this boom in the asset bubble, especially of COVID stocks, right? With the Pelotons and everything of the world. What was just so interesting to me is looking at those charts. Everybody's like, they're down 70, 80%. I was like, yeah, because they were up 300%. But what you and I are talking about is they actually round tripped to like where they were in January 2020. So like, what if it was, the world is full of sound and fury, in the end signifying nothing? And people would say, well, then we got a lot of feedback, a lot of hate that people are saying, well, it benefited the wrong people. And I would argue that, everybody's worried about wealth inequality, and I am too. But the only thing I think historically that really brings back that Gini coefficient or the wealth inequality is actually asset bubbles crashing. So actually people should be happy that these asset bubbles are crashing, because it's usually the wealthier that actually can own assets. And so as long as unfortunately right now we're seeing commodity inflation that leads to food inflation, so we have to worry about that. But in general, could the Fed have done a decent job? And now we see the asset bubble imploding. Is it just bringing back the wealthy that had assets explode 300%? Now they're coming right back down to par that they were before the pandemic.
Yeah, and it's also tough to consider, right? A lot of this inflation or inflation risks we're seeing right now are being driven by the war in Ukraine. Yeah. And all sorts of sanctions against Russia. Now, one might argue perhaps Russia strategically chose this time to attack because there was already global supply chain issues and knew it would put pressure on the West from an inflationary perspective. And that was part of their economic war that they knew they'd eventually have to get into. I don't know. That's sort of, to me, maybe four-dimensional chess. I'm not sure they're playing that game necessarily. But it's, again, hard to consider the counterfactual of if Russia had not invaded Ukraine, if we didn't have these sanctions, less pressure on oil, less pressure on agricultures coming out of the Ukrainian breadbasket, would we be potentially as concerned? It's hard to say. Look, the Fed ultimately can't fix supply. They can only fix demand. But we were going to run into a massive demand issue during COVID, right? If everyone all of a sudden was unemployed. So they had to perhaps use a bit of a bazooka to keep the engine running. I don't know why that metaphor, what bazooka and engine did not go together at all naturally. This is the problem with live episodes, people. This is why I don't do this. That doesn't make any sense. So anyway, the point is they potentially stepped in to keep the economy running at a time that the economy could have gone into a really violent tailspin, and we'll never know. We can all sit back in our comfortable armchairs and hypothesize about what would have, could have, should have happened. Maybe they did too much stimulus, but I would argue the risk is probably greater if they do too little stimulus than if they do too much, right? Like the question is, what side should they err on? They should probably err on the side of too much, and then try to just have an inflation in asset prices that then dissipate over time.
And I think what I was referencing, my question was really, what's worse? An acute recession, like if they didn't step in, like how bad would it have been in over like a 2 quarters of 2020, or are we going to deal with like a multi-year recession now? Like what is worse for the average person? I don't know the answer, but that was kind of like more of the broader question. By them saying in, we postpone it and probably have a more prolonged recession, but just an acute disaster might have been a lot worse than a prolonged recession.
Right.
Jack, how are we doing on time?
We are doing great. And I also like the fact that this is the most you guys have talked about macro on the show. So the way that I got you guys to talk about macro was by asking like, what's the dumbest macro take you've ever seen? So
yeah, and then I try to dump on Jason.
Yeah,
it's perfect.
All right, so this one's a different flavor. The discrepancy between valuations in public markets and private markets has continued to widen. How should allocators be thinking about this?
Well, Jack, what are you seeing in private markets right now for valuations?
Yeah.
You're not seeing the line go down as much, right? Because there is no line.
Right.
But I can't talk. No, it's not my. It's not.
I like that,
Corey. I know
guys,
you're gonna. Yeah, you're gonna have more nuanced thoughts on this, but the first thing I want to point out while you're thinking, but give you time to think, is that what I always found fascinating is prior to the last decade, right? There was an illiquidity premium, like you had to actually provide better returns for illiquidity, and it's amazing how always narratives change, and how we've almost changed the narrative to like say now actually illiquidity is a bonus because one, I don't have to take the mark to market losses, and therefore I'm not going to panic sell, and then it's also a bonus because I can't do anything stupid. Right? Because that money's locked up for 7, 10, 15 years. And it's just interesting how the narrative has changed is like, we used to want to get paid more for illiquidity. And now people have almost flipped that narrative around. And it's probably coming from the PE and VC hedge fund managers that, that actually illiquidity is a good thing for us in a behavioral context.
Yeah, I mean, I just, while you were talking there, I checked on one of my private investments that I made back in 2013, which I've laughed about on Twitter. This was back in early 2010s. I was like, I think it's a good idea to get involved with seed stage investments in tech. I think this is the right environment for it. And so I made some private investments in a seed stage fund. I have never seen, I take that back. I saw one slight bit of liquidity. In theory, I'm up 500% on the investment. I mark it to zero because I'll never see it, but I'm laughing because it's now May 2022, and the last fund performance update I got was Q4 2021. So as far as I'm concerned, I haven't lost anything this year. But if you look at sort of the Refinitiv, who has a private equity index that they publish, I mean, the private equity stuff has just fallen apart. And if you look at what private equity investors or private investors tried to bring to market through IPOs and SPACs over the last 2 years, those are all down 75, 80%. So I think the marks are likely to be a disaster. That said, again, it was a big run up post-COVID as well when you look at that index. So it's sort of, again, doing the post-COVID round trip. From a public valuation standpoint, my friend Guillermo over at New River Invest has some interesting charts where he's been breaking down valuations into the different size cohorts. And from a historical percentile basis, if you start looking at small or mid caps, they are historically starting to look fair valued to cheap. Now, again, it's a little bit of an odd mix because there are some forward-looking earning indicators in there. Those might all be, this is analysts with their crystal balls. Who knows if those have to be, marked down for what true earnings will come in as, and current prices will actually be expensive relative to future earnings. But it's really the large caps that are expensive, and it's not even your average large cap. It's the growth large caps. It's like you would need, if you want to get back to like 2018 levels of relative valuations, you need something like Microsoft to fall another 25%. You would need Apple to fall like 35 to 50%, which seems unlikely. I don't think that's where the trough is going to be ultimately in this sort of whatever market drawdown we have here, perhaps. But it is truly like those FANG generals of the market that are keeping the mega cap valuation much higher than the rest of the market, which has already come down quite a bit.
Yeah, I think that I think when Jack has these questions, he needs to come with data and charts so he can prove to us that what's the valuation difference. And part of that is like the delta of that valuation difference. Like both have come down, multiples have come down, but I wonder how much the delta has changed between public and private. And I haven't run a study on that.
Well, how do you even value private, right? At least in public, I can talk about what the PEs are. Private, it's like a lot of this stuff doesn't even have E.
Right. Well, and then part of it is like, at least you're hearing from VCs, at least the multiples are coming down on pre-money valuations too. Like they're not as insane as they were, in the last year or so. But part of it, like you said, there's no E there, but I wonder, there's different levels to this game. And part of the private side that I think people don't think about a lot is like real money allocators, institutions, pensions, endowments, and everything. They love PE, even if they're not going to get the IRRs or the returns they've been accustomed to, or that are part of their historic examples. Though, like you just said, on your mark to model, you keep making money on yours. So if I'm running a public endowment or a pension or whatever, I love PE because of the lack of volatility in those marks. And so over time, it just keeps looking like I'm doing my job. And if I only have that seat for 3 to 5 years, I'm going to look like a hero if PE doesn't blow up. So you have this constant bid to PE, even when they know that it's probably not going to return, or it might return less than the triple Qs. But it's the ability. You have to think about the different levels of the ability of the mark to model system, and having that lower vol on their books. They'll take that every time.
By the way, I looked at the end of last year. I think since I invested in this private startup fund, the annualized return was almost identical if I had just invested in the Qs. Which I, again, I think, okay, so how much has the fund return probably come down? Probably by how much the Qs have come down.
Yeah, I would guess that ratio delta is like relatively the same. Jack.
All right, Jack.
This is good. We're moving at a good clip here. I just want to make clear to the audience that, Corey, when you said PE, you were referring to price to earnings ratio, like P/E, PE ratio.
Yes.
And then when Jason said PE, I think he meant private equity. So
it's amazing.
And also,
I was saying the same.
Good catch.
Yeah. Jason, I also was laughing when you just said the phrase, there's levels to this game.
One of my favorite phrases.
Yeah, no, it's a great phrase. All right, so here's this question, which is that there are a lot of the risks that you'd encounter if you watch TV, you listen to podcasts, you're on Twitter, are macro risks. Like, the dollar is going to ruin your portfolio, the Fed, inflation, the recession. What are the actual greatest risks that investors face, or the practices, beliefs, or their own habits that lead investors to ruin, rather than external macro phenomena that people hear about?
Ooh. I can go right away if you want. One, I think.
Yeah, have fun.
When I started, yeah, exactly. Jack is setting us up for a compliance nightmare. When he started the question, I was thinking the obvious risk that people aren't accustomed to with like 60-40 portfolios, which is, let's be honest, the vast majority of people on target date funds are 60-40, and obviously the correlation risk that we have during rising inflationary. It's when stocks and bonds get correlated, as we've seen, all too often this year. You can have them go down together, and I think that's what people are fearing in their portfolio. But like Jack was actually then finished the question in my understanding of asking what are the risks almost outside of that, and I think a lot back to the babysitter tax, right? This is a terrible term, and people hate the idea of a babysitter tax, but this is essentially what people pay financial advisors or hedge fund managers for, is so we don't do anything stupid behaviorally. Like, it's understandable, like we were just saying, human incentives, we panic, right? And during 2008, so many people sold right at the bottom, didn't get back in, and missed that V-shaped recovery that it took longer than in March 2020. And so I think there's a great study on like Peter Lynch, right? At one point, I think his annual returns were, don't quote me, but anywhere from like 18 to 22% annually. The average investor was -1% CAGR, because once again, they're trying to performance chase. And I think that's what people kind of miss the most, is performance chasing and trying to jump in and jump out, and timing the markets is actually more detrimental to people's portfolios than anything else. And this sounds ironically that I'm going back to saying people just index and buy and hold, which is not necessarily what I'm saying. I believe in broad diversifications of asset classes and then rebalancing. But it's interesting that it's typically not your actual portfolio construction, as long as it's prudently diversified. It's your innate ability to want to time the markets or panic at bottoms and miss V-shaped recoveries, or listen to and let the financial media scare the shit out of you. And then the one I tend to point out often that usually gets a chuckle out of people is like, the number one thing you shouldn't do is get divorced. You just chopped your AUM in half. So maybe you should think about who you're marrying more than what your portfolio construction is.
Yeah, I think the obvious answers here are probably behavioral, right? Paying too much creating too much in realized taxes.
Paying too much for car insurance. That's all I could.
Yeah. I mean, look, there's some things you can control and some things you can't. I think from a long-term asset allocation perspective, you can do a lot worse than just recognizing the fact that to earn return, you have to take risk, which means you should probably diversify across a global basket of positive expected risk premium asset classes like equities and bonds around the world. Probably even include commodities there. I'm hotly debating whether commodities actually have a positive expected return or not, but create a well-diversified basket and recognize that you're getting paid over the long run in compensation for the risk you're bearing. And you want to make sure that you are actually bearing the appropriate amount of risk, because to earn that return over the long run, you have to be able to survive the short run. These are like, I don't want to say finance 101, but like investment 101 concepts. And when you build that portfolio, don't overpay for it. Don't create unnecessary taxes, and just try to ignore the short term. If you sort of believe in prospect theory that for every like 1% gain, the joy you feel is like twice as bad for every 1% loss, then the more frequently you look at your portfolio, the worse it's going to feel. Because on a day-to-day basis, the market is up and down, like, 50% of the time it's up, 50% of the time it's down. But if you look on an annual basis, it's up more like 60 to 70% of the time. You look over a 10-year basis, it's up almost all the time with the, at least on a global equity level. And if you talk about global equity bond diversified type portfolio, you start to get to the point where there's a high degree of probability that you're going to have positive returns. So it's really looking too much in the short term and taking too much risk in the short term that can knock you out. So I think it's for the most part behavioral. I do want to touch on one point on that. You brought up a great story, Jason, about Peter Lynch and people involved. You're seeing that with ARK today. I think 20 years from now, people will talk about ARK in the same way, where a ton of money piled into ARK. And you even see at the market level, over the last 2 years, there's about $1.3 trillion that came into global equity markets that is now currently underwater from an average investment from where they got in. So you talk about sort of like all that money that came in post-COVID is now on average underwater with the current returns in the market. So, you just, there's no pain, no premium, no risk, no reward. This is just how markets behave. And if you panic and sell out at the bottom, that's hard to recover from.
Yeah. And I've been doing my best not to look at the comments, but I can't help. I'm like a dog with squirrels in the background. I'm like, squirrel. I can't help looking at it. And I just want to point out, Sean said something good too. Is like, I wasn't shitting on financial advisors and the behavioral babysitting tax, which is just a priority I was talking about. Like, but Sean, at the same time, you have to admit that like a lot of financial advisors are just 60-40 in target dating, but like the better financial advisors are doing an amazing job at like financial planning and really working with their clients and their families through lots of different phases of their life, especially with entrepreneurs, where they're selling their companies and how to have a tax advantage sale and everything. But those are kind of few and far between. A lot of financial advisors are just putting their clients into 60-40 and calling it a day. So that is the great differentiator. And I do believe that's the future of financial advisors, is they're going to outsource that CIO function on the investment side, but they're going to do an amazing job of value add on the business, tax, estate planning, and dealing with, how you structure a family dynamic. So
the other comment I want to address here is the ceiling fan behind Jason.
Yeah, your ceiling fan.
That is not Jason's ceiling fan. Again, he's at my place currently, sitting in a different room. That's my ceiling fan. I'm renting this place. I don't know what to tell you. This is the weirdest fan. It goes both directions. I don't know who designed it.
It's like Blade Runner. But by the way, Corey, how do I turn on this fan above me? I'm sweating my balls off out here.
If you go to the wall to the ceiling on the right, yeah, turn that all the way.
That knob. All right, Jack. Next question.
All right, Jason, I'll burn some time because I got something to say, which is that I recently interviewed Peter Lynch's right-hand man, George Noble, and he brought up the exact same point. And he said, look, everyone knows Magellan Fund, we had 30% returns. But if I had to guess, what did the average investor get? I'd say about 10%, because they invested at the very top. And he applied that same framework to ARKK. When you look at the chart from 2014 and compare it to, let's say, Berkshire Hathaway, it's still like by a little bit outperformed Berkshire Hathaway. But that's if you bought at the very beginning. And of course, people buy at the top. That's why it is the top. So Can you just explain the concept of dollar weighted returns, Corey, and what that indicates? And then also what I originally was going to ask, which is what do you make of the continued inflow into ARKK despite its record drawdown?
Yeah, by the way, Jack, I really love that people keep buying into the top. That's what makes it the top. I think that's actually like a really trivial thing to say, but very insightful, frankly, because like tops are made when the marginal buyer does no longer outpressure the marginal seller, right? And so people always say, oh, look, everyone sells at the bottom. No, the people selling is what makes the bottom, right? Like that's why it looks like everyone always sells at the bottom. That's how the bottom's created. You run out of sellers. What is dollar weighted average return? Basically what you're looking at is you're not just looking at the fund performance, you're looking at when dollars came into the fund. So let's say a fund has $1 invested in it and has 100% return. And then all of a sudden, all this money floods in, hundreds of millions of dollars floods in, and then the next year is down 99%. Well, it would, on a dollar weighted basis, look like it has absolutely horrible returns. Well, it has horrible returns anyway. But the point is, all the money that got invested never saw that plus 100. It only saw the minus 99%. Even that first dollar had a bad ride. But the point is, it's about when did the money come in. To your question, Jack, about ARK, I think this is one of the interesting dynamics we're seeing in the current market that was different than March 2020. I was writing a bit of a piece to some of my clients. I haven't finished it, but the idea of like, what does a capitulation checklist look like? How do you know when the market has capitulated? And a lot of what you saw in March 2020 was forced leverage being unwound, or leverage being force unwound, right? And in a market environment like this, a lot of the levered players are no longer levered. They've already degrossed their books. No one's being forced to sell anymore. And so what happens is you just have very stubborn long investors who have been trained to buy the dip over the last 15 years and been rewarded for it. And they're looking at trying to buy the dip in the stuff that they think will have the greatest asymmetric rebound. Some of that is the tech growth names that have sold off the hardest. I mean, if you look at the price to sales valuations in a lot of ARK's holdings, right or wrong, they've more than round tripped. They are lower than they were in March 2020. Now, maybe they were priced incorrectly in March 2020, but one might argue, like, for speculative tech, they are now cheap. And so if you think there's going to be a market rebound, great. If you think the S&P is going to bounce 10, that's a great place to get plus 20, plus 30 potentially in the next little rebound. So I think there's a lot of that going on. And then I think as well in these sort of environments, you just get the narrative believers, the diehard Tesla investors, the diehard ARK investors. And from a behavioral perspective, when you state that you are going to make an investment, it's hard to turn around and do the opposite. People like to remain publicly consistent with their statements. And so once someone starts publicly declaring themselves an ARK investor, it's hard to turn that around.
Yeah, there's a couple of things. One, Jack, thanks for coming up with the numbers from Magellan, but I think the delta is about the same. It was just always the most egregious example of average investor's path versus Magellan path. That delta was like 20. There's a lot of like academic literature. I've seen like 6 to 8% is like the average, like usually babysitter tax. And then once again, like Corey said, the buy the dip is like, quite frankly, Jack, like your generation's been structured around buy the dip. It's worked tremendously, especially in crypto. So the same thing with tech investing. So it's like when you have that buy the dip, and like Corey's saying, we haven't seen like cascading liquidation. So we haven't seen like a true panic yet. So until like you really that buy the dip enforcement it's got to get kind of worked through the system. And I think that's the biggest part of it. It's still BTFD. Like that's the way everybody's looking at it. I mean, people the other day were buying me and stuff like that still. So you just never know like what people are still trying to YOLO and try and do that. By the way, I want to give a shout out to Caruso. Said the most improvised podcast ever. Love it. At least we got one fan. That's what we're going for. Jack, next question.
Yeah. So I want to ask you guys about the narrative that I've been encountering a lot is, the reason crypto is going down is because of the Federal Reserve. There's going to be a recession. The Federal Reserve is hiking. My question is, I take it, because you guys are not narrative people, you're definitely not you're going to take that with several grains of salt. My question is, to what degree is it possible to have a rigorous view on whether that's actually true? And on the face of it, it kind of seems like the Fed funds rate went from 25 basis points to 75 basis points, and that's why this $50 billion project collapsed. Like, I don't really buy it. So, but how do you even go about having a view on whether that view is right or wrong? I'm not.
I'll start with, and because Corey and I were posting all those memes to each other the other day, and one of the ones is like that picture meme where the person's looking in the mirror themselves and pointing at themselves, and one of them was like that we saw that came out of, was it 4chan, Corey? The idea that like Citadel and BlackRock conspired to take down UST, and yeah. I mean, behind the scenes, in hindsight, we'll find out if there's any collusion or anybody trading that, but that meme, yeah. This one's my favorite. Yeah, you didn't invest in Ponzi shit coins. It was Citadel and BlackRock who were responsible. It's like the lack of like self-responsibility. I love that one. It's like, it's just like you said, Jack, let's blame the Fed. Everybody loves to blame the Fed. They're like the #1 punching bag. And like, how do you blame the Fed for not doing due diligence to realize like an algorithmic shit coin is never really going to work? So I don't know how to answer that other than that.
I would attack this one. I hate when people say I'm going to attack it from first principles. I'm going to attack this one.
You're going to set me up. Now let me, before you do that, I just got to say, whenever I hear anybody go, I went back to first principles, I just go, they haven't thought enough. Because if they thought enough, first principles wouldn't exist. First principles only work in physics. Everything else, you're just fooling yourself.
Yeah. Look, I think the core question here, when anyone posits a macro theory, or really any market theory, I think this is fair game for any market theory, is by what mechanism? By what mechanism does the Fed raising the federal funds rate have knock-on impact into the Luna Terra system? Right? Lay out the mechanism for me. Because you can't just say it. You like, if that's your theory, you need to tell me how this flow works. This flow of capital that suddenly takes down Luna Terra. And I don't think that's like a very niche example. Yes, crypto sold off as an ecosystem pretty hard over the last 2 or 3 weeks. I think it's down 50% or so. Was that from a Fed hike? Was that from inflation fears? We are seeing an increasing correlation with equity markets. What's that coming from? It's like, if this stuff was easy, we would all be billionaires, right? The fact of the matter is, like, your null hypothesis should be that markets are efficient. Most of this is random noise. You can't forecast where it's going. There's no easy linkages. It's all priced in. And if everyone knows the Fed is hiking 50 bips over the next year, great. It's already priced into everything. Or 50 bips over the next 2 meetings. It's already priced into everything. So I think the hard point for me is saying, like, okay, the Fed hiked and crypto therefore sold off. Like, what is the mechanism? And I don't think anyone can come up with a clear mechanism for me why crypto should have to sell off. You can make the argument, like, by the way, that like assets with cash flow all have in the denominator, right, an interest rate. And so as interest rates go up, therefore the net present value of those assets should go down. Great. I get that with stocks and bonds, and they should reprice the changing interest rates for sure.
But how does that affect a stable coin?
Yeah.
Right? Yeah. Like, that's what you're saying. Like, if we're playing the duration game as they raise rates and long duration assets come down. But like you're saying, like, what's the mechanism for a stable coin? That doesn't make any sense. It's not like
there is an argument I've had. No. I will say the only maybe mechanism, and I'm glad Ari Pine is definitely not in the chat, and he definitely isn't listening to this. But I've had this argument with Ari Pine, where Ari has said, look, crypto doesn't exist. Like, Bitcoin doesn't exist on its own. There's always a denominator. Right? A share of Coca-Cola doesn't exist on its own. There's a denominator, a numeraire that is $1. And he would argue that the changing interest rates has an impact on demand for the US dollar. And it's not that Bitcoin's going down, it's that the dollar is going up. That could be a mechanism. And I will say I have not thought hard enough about that concept, right? Because to me, it's weird. Like, dollars are priced in other assets as well. Like, what is the value of a dollar? Well, in compared to what? Like, you're buying goods and services. Everything's sort of,
it's relative value all the way down.
Yeah, it's relative value all the way down. Perfect, exactly. So it's hard to say like it was the dollar that went up, not Bitcoin that went down. Well, but that to me could be the mechanism by which, if changing interest rates change demand for dollars, and therefore dollar relative value went higher, compared to everything else. It's not that Bitcoin lost value, it's that the dollar gained in value, and that's the denominator aspect.
There's a couple of things I want to say on that. One, I'll start with, why are you yelling, man? I can hear you through these glass walls. I mean, no wonder you have such a deep baritone. You're just yelling into that mic while I'm whispering out here, so I don't know if affect neighbors. Jack always likes to paint me as I hate macro, which is not necessarily true. I just can't stand these narratives. And like Corey, you're saying, by what mechanism? Even if we could figure that out, I was just having a conversation at breakfast this morning with Adam Butler about the idea of consequentialist philosophers. They're to me, the worst form of philosophy that's ever existed, because the idea is you could see a causal chain, going 10, 12, 15 moves out, and how it's going to be affected around the world. That's just insane to me. And I think Henri Poincaré even proved that with billiard balls. By the time we get to the third billiard ball and the consequences there, we have to take into factor the rotation of the earth. So that's with billiard balls on a closed system on top of some felt. Like, how are you going to interact with 8 billion people and then think you have a consequence and a mechanism that's going to have a cascade of consequences that you can predict personally going out into the future with all of the intervening, action, reaction, et cetera? It's just insane to me.
I once heard someone say that history should be taught backwards, because the way we teach history forwards, everything seems like the natural consequence, as if it was preordained and we could predict what that consequence was of all the actions. Whereas if you teach it backwards, you sort of lose that mindset. It's an interesting, I agree with you. Like, you start to branch out the potential consequences of the future, and it becomes a very scary, multi-dimensional problem very quickly.
Jack.
Long story short, Jack, I have no idea.
Okay, that makes sense. I think there's sort of, you said people have no idea. There's no narrative. There is a narrative, and you both know it, and most people in the audience know it. It's that you're raising the cost of capital for loans, and if people own things on leverage, that's going to get flushed out. Also, you're making risk-free assets more attractive. You're going to sell 3-month treasuries to go in the Fed funds. You're going to sell a 2-year treasury to go into 3 months. You're going to sell a 2-year treasury to buy a 10-year note. You're going to sell that to buy Coca-Cola, some really boring stock. You're going to do that to buy ARK. You're going to sell ARK to buy crypto. And it sort of goes out on the risk curve, and you have a bullwhip effect by the thing that's farthest away out of the risk curve is the one that moves the most.
So what are you selling crypto to buy?
That's my thing. I don't buy that people are selling stable coins that earn 20% to get 75 basis points. It's just who the crypto bros, who do they. And the crypto money is not, I get it's internally levered, but I don't think it's externally levered, right? It's not like they're getting margin calls because except for Sailor. Sailor is the systemic risk to Bitcoin, right? Like in micro strategies and the debt they took out. But it's not like the vast majority of VC money or any part of VC money is debt capital, right? This is all equity funding that's going into these projects. And I couldn't even really take out debt to put money into Coinbase to buy crypto if I wanted to. I mean, I guess I could run up a credit card bill, but I would speculate that there's very little debt capital getting pumped into the crypto ecosystem. So again, changing the interest rate there to me is it's not the driver. Again, the dollar narrative is an interesting one to me. I haven't thought enough about it. Yes, I think there definitely is leverage in crypto, but it's I guess you could say non-recourse maybe because it sort of decays on itself. Whatever. I'm getting to a point where I'm
sort
not
of like
making
endogenous. It's endogenous to the system.
Yeah.
And therefore not exogenous. Like the input to me is not necessarily the Fed funds rate there.
So like Corey said, they're coming in on the equity side, and then they're rehypothecating, to your point, Jack. That's how they are able to build leverage within the system and just keep like rehypothecating into stables, and then you're just building up more and more leverage. That's why I say, that Terra wasn't around for that long. Even if it's 30 billion, hasn't been as long as Tether. Whereas if Tether depegs, you're going to see a cascading of leverage scenarios, a liquidity cascade, if you will, that will send shockwaves throughout crypto and potentially can reverberate into TradFi markets. That's the one that I think could actually reverberate into TradFi a little bit, is if you saw Tether depeg.
Yeah. All right. My final question, which by the way, people say it's improv. First of all, the entire show that we've always done has always been really improv. But this one is, I have written the questions before, but yes, Corey and Jason have not heard them before. But this is, and I think the format's worked. Talk about causal. I think the audience is kind of vibing with it. But I was going to say, the question, the Federal Reserve, there's a Fed put. The credit market's going to crash. That's all narrative about intent, about how the Federal Reserve weighs inflation versus recession. We don't know. It's speculation. However, would you guys agree with the following assertion that the credit market now, as judged by option-adjusted spreads, is nowhere close to a crisis situation, and that credit spreads remain quite low?
This is a great question, but can I answer something from the comments?
Sure.
First, Karutsu says, I do not understand why you're puzzled. People don't have any more money to put in because everything is more expensive, hence more sellers than buyers. I don't have an issue with that narrative.
No.
But that doesn't mean the Fed increasing interest rates caused that problem. The Fed increasing interest rates was coincidental to that problem, which is we have an inflation issue. So people, first of all, I know plenty of people who lost money trading stocks and trading crypto, and the marginal buyer's gone. So you definitely have that. And then they're getting more pressure from inflation, so they can't necessarily dedicate as much to speculative assets. So I agree, the marginal buyer's gone. But that wasn't because the Fed hiked rates. The Fed is hiking rates for the same reason as those issues. So again, like my point is not that a crypto shouldn't be down right now or shouldn't be sensitive to some of these same macroeconomic factors. That's totally fine with me. My issue is people saying the Fed hiking rates is the reason crypto is down. To me, they're the same symptom of the cause. I don't know. You know what I'm trying to say.
Yeah, and all right, I'm gonna go a little bit macro, but so hiking rates changes the price of money, but not the quantity. The quantity is changed by quantitative easing. And you've seen bank balance sheets and particularly deposits explode when there are periods of quantitative easing. Some people say, oh, it's just an asset swap, it's not money printing, because the treasuries are taken off the market, and treasuries is money. Treasuries are money. True, but when the Treasury issues a ton of treasuries at the same time, that combination is unequivocally money printing. And yeah, we are seeing the reverse happen. Also, CG is saying Hollywood falling asleep listening to these laser bros. Couldn't be farther from the truth. I'm really enjoying this. Corey, you want to go in the credit?
Yeah, I mean, I don't really know what to say here other than if you look at option-adjusted spreads in high yield or you look at credit default swaps, credit default swap indices have been ticking up, but they're nowhere near where they were in, say, March 2020. They're not even at 2018 levels last I checked. So from the view of, is there credit risk in the system? Credit default swaps and high yield bonds would say no. It's worth considering, though, right, that the constitution of equity market indices and high yield bond indices is very different. High yield bond indices tend to be much more industrials focused, and those are companies that are printing cash hand over fist right now and have tremendous free cash flow and ironclad balance sheets because commodities that they're producing are going for so much. So it's worth acknowledging that, right, the high yield market isn't necessarily representative of the economy as a whole, and it might be worth looking at the creditworthiness of some of these other sort of sub indices that are perhaps a larger part of the equity universe.
We got a comment from Randy Woodward, who I know on Twitter is knows his stuff, a reader of Zoltan Pozar. He notes that high yield option adjusted spreads are out 100 basis points in the last 30 days. That is correct. I think, especially over the past week, there has been some widening. But if you look at it on the chart since 1997, we're still in territory that's nowhere close to a recession. We still have so much further to go.
Yeah, I think we're still sub 5. We definitely saw north of 5 in 2018. In Q4 2018, and then like 2016 we were up towards 9. 2020 I think we were, I don't even know what you would call intraday, but we were definitely north of 10. So we're maybe towards 2018 levels. I didn't pick up on the last week. We were plus 100, but we're nowhere near 2015 2016 credit concerns, and absolutely nowhere near 2020 credit concerns.
But part of that is like first of all, I want to give Jack his flowers. Jack, you had excellent questions today. We didn't know what they were going to be. We figured we probably weren't going to want to answer half of them. But for those that don't know, Captain Jack is definitely going to fit in a few interest rates or credit questions. He loves his rates and credit spreads. But like the first thing I thought of too is like almost we bring it fully back to the beginning with Hyman Minsky and stability breeds instability. Is credit spreads being lower? Don't tell me anything other than there may be hidden fragility in the system, and it's much more like the rate of change. Like shout out to Randy saying it's plus 100 bips. I'm more concerned with that rate of change, or credit spreads widen after the fact, right? It's almost like the police aren't there necessarily to prevent a crime. They're there to take notes after and figure out what happened and maybe try to catch somebody that was responsible. So that's kind of like credit spreads. Are they a leading indicator or a following indicator?
It's a good point. I think the price is what the price is. And also you can't look at a chart and say the market is telling you this. A perfect example would be a forward commodities curve. The price of oil now is 100, but in 2024 December it's $70. That doesn't mean the market is telling you the price of oil will be $70. No, it just reflects like people are selling a lot in the future because they're producing or something else. And typically backwardation, when it's downward sloping, is actually a bullish sign. And I guess the ultimate example would be, and this confused me. Powell said, at the presser that 75 basis points is off the table. I'm paraphrasing. He was obviously more like hedged, but the markets still were assigning a like 75% chance to a triple hike in June. But I'm realizing no, like they're just people who are hedging. They're not trying. The markets do not exist to tell you what is going to happen.
Yeah, that's spot on. I think,
as they're saying in the comments, the king of forward guidance. The Fed whisperer. I mean, you did name your show Forward Guidance, right?
But Jack, that's spot on. I think people get this wrong about derivatives markets a lot, as they try to back out what derivatives markets are estimating is going to happen, and I think they're failing to acknowledge that there's a utility component that I might buy deep out of the money puts, not because I think the market's going down, but because I'm hedging a particular path that I am sensitive to, right? And if a large group of people are buying a 75 basis point hike, Fed funds future, because it's not because they're making that bet, they might be hedging a particular set of risks that they have. So it's not always easy to read into futures curves, forwards curves, options markets, and try to extract what the market is forecasting.
Yes, the same is true for Eurodollars curves. People who just want to have a hedge. And I also made a realization, which it seemed more profound to me than it's going to seem to you two and the audience, but I just want to share, which is people say, there's a hump in the Eurodollar curve. This is a sign of trouble because the Federal Reserve has to cut. But if you think about it, the Eurodollar curves goes out for 10 years. So if there was never a kink, if there's never a hump in the Eurodollar curve, that would mean that the market is currently pricing in that the Federal Reserve was going to hike for the next 10 years. And it's just going to rates are just going to grow to the sky. So of course, at some point there has to be a little curve, at a point where a forward point is lower than the previous point. So yeah, I just had that thought.
It's also baked in inflation premiums in there, right? So I think we talked about this in the past on the show, that if you believe inflation will be high for 3 years and then low for the next decade, right? Anything past the 3-year point might have a thinner inflation premium built in than you would have in the first 3 years. So there, right? You've got a term risk premium, you've got an inflation premium built into all these things, and it's not like just because I think inflation is going to be high today means I think it's going to be high 5 years from now.
Mm-hmm.
And shout out to Clout Casino. Can anyone imagine the Michael Saylor margin call documentary? That'll be the fire sale of our lifetime. That's the kind of questions I'm here for. Like that would one margin call phenomenal movie, but again,
so good.
The Michael Saylor movie is going to be incredible.
Yes, I will say so. I've looked into it's not like the bank can just seize the headquarters of MicroStrategy. It's a series of convertible bonds that are kind of, I think, unsecured, and they're like 5 years out. So it's not as if there's going to be, if Bitcoin goes to $10,000 in over the next 6 months, the price of MicroStrategy will likely go lower, but it won't be an automatic zero if it,
right.
in an end run scenario. You know what I mean?
Yeah. They're going to be walked out in cardboard boxes. Yeah.
Cool. I'm gonna leave. How about you guys give an outro to the audience and send us off to the week?
I like that he cut himself off before we even got full sentences, Jack. Well, everyone, thank you for tuning in. Thank you for sticking with us for the first few minutes there where we had some real technical issues. But again, this has been a fun new episode format for us. We're still trying to figure out, these different formats. So let us know in the comments if you like this format of Jason and I not knowing what's coming, if you want us to talk long form format, or if you want sort of just do it week by week. Again, I'm Corey Hoffstein. You can find me at Twitter at @CHoffstein. That man sitting on my porch is Jason Buck. You can find him on Twitter at Jason Mutiny. The man behind the scenes who just took himself off the screen is Jack Farley. You can find him on Twitter at JackFarley96. This is Blockworks. Please don't forget to like and subscribe. Thank you for tuning in. If you're listening later on, thank you for your time. We appreciate it. Have yourself a wonderful day.
And if you are going to Permissionless next week by Blockworks, I'll be there. Please say hi. See you, everybody.
I had a great outro.